We are in the Money Show today, being joined by Anil Rego, who is the founder and CEO at Right Horizons. Welcome to the show, Anil, and thank you so much for your time. My first question to you on this aspect is related to the borrowings, because when interest rates rise, we see it in two perspectives. Firstly, that this is expected to impact your borrowings. On the other hand, it could give some cost pressures as well. So firstly, talking from the borrower's point of view, we now have home interest rates and at all-time low, and even the personal loans are quite cheap comparatively. With interest rates expected to go up, what should be one strategy with respect to borrowing? And is this the right time to grab some loan? And how do you see what impact the rising interest rates can make on your borrowing? And how should one concern be regarding this?
Firstly, the good news is that interest rates are very low right now, and you can see that from if you want to go and borrow and buy a house, typically interest rates will be less than 7%, which is come down substantially from the past. So it's probably a good time to go back and buy a property if that was on your mind and you wanted to do it. Interest rates will be favoring, and also at this point of time, real estate also prices have not done too well, so you may get a better deal. It's a good time to look at it. Now, coming back, if you already have a home loan, right, what do you do? Or you even have a car loan. Yes, this is interest rates are very low right now. So the first point that you need to keep in mind is you need to check what are the market interest rates, okay, versus what is in your loan. And if your loan has a very high interest rate, then you can try and do two things. One is maybe search for a home loan company who will give you, let's say, a fixed rate of interest. Okay, so that even if interest rates do go up from here, which is the expectation, you would actually end up locking in your rates at the current lows. The other thing that you could do is you could also refinance it. Now, it will not help you if you anyway have a variable interest rate loan in the future, but at least it resets you back to a lower interest rate. And if interest rates go up in the future, you will probably find yourself back to square one, and you've saved yourself some money in the intermediate period. So I think these are the couple of things that a home loan buyer can do. Of course, if you have a bike loan, etc., those have lock-ins, and you need to go back and see what is the cost of refinancing, as well as is there some exit charges that they have. So that is one point that you need to keep in mind. But for most home loans, you typically you'll not have an exit interest rate, unless sometimes they have a bit of refinancing, but you could probably go back to your same company which you borrowed from and try and renegotiate, and most of the time they do that with a small processing fee. So this is a good time for you. Please go ahead and make those changes.
Okay, thanks very much, Anil, for that perspective. So this was from the borrower's point of view. But now if we try and look the hike in the interest rates from an investor's point of view, for now we know that the fixed interest rates and even the small saving rates are very low and not that lucrative. So are they expected to go up along with the inching of interest rate that is expected? And along with that, I would like to add one more question to that. How much do you expect that the overall interest rates will shoot up in the times ahead? Any time horizon, if you can help with, and help us with a plan, investment plan for our viewers, what should be their strategy?
Yes, first of all, interest rates are very low. So this may be the worst time to be in the debt market. If you want to, let's say, invest in a debt fund or a bank FD, you'll probably find really poor rates. You may not feel like investing in the current markets. So that is true. The question is, how much and how fast do you think interest rate would go up? I think it'll not go up in a great hurry. You would find that there is some bit of uncertainty globally. So regulators also will want to keep interest rates a little easy. And while they may look at some bit of the easing that happened and releasing some of it, you may find that they will not do it in a really hurried way. So we think interest rates may take some time, and over the next 6 months to 1 year, we think that we could see reasonably higher interest rates and possibly going down to next year or two. So there's no need to be in a great hurry to look at instruments which really go up in terms of interest rates. So unfortunately, it doesn't make sense yet to invest in long-term bonds. So what is it that one can do? Okay, we could look at instruments like floating rate instruments. You could look at corporate bonds, corporate bond funds, as well as if you are in the very high tax bracket, you can do some of the arbitrage funds. Now, within the most favorable right now, maybe the floating rate funds. And what are these floating rate funds running at? Yields are somewhere between only 4.7 to 5.7%. Great right now, but the point is, over a period of time, one thinks that they will go up. And a fund that you could use is something like, let's say, a Kotak floating rate fund. Now, the other category is you could look at corporate bond funds. Okay, and don't look at funds with a very high duration or investing in bonds with higher tenures. You could look at ones which are probably in the 1.5 to 2.5 year range. And you could look at funds like, say, Nippon India Corporate Bond Fund, which is a good fund for you to consider. And you also have a category which is called dynamic bond funds. And some of the dynamic bond funds, basically, they by the name, they are dynamic. So they would keep that interest rates are expected to go up, and they would have reduced the modified duration. So look for funds that with a lower modified duration, and maybe a Kotak dynamic bond fund can be one way. And the fund manager then moves around between high interest rates and longer tenures, shorter tenures, and takes care of it for you, and possibly look at dynamic bond funds only if you are looking at a very long term. Okay, maybe 3 years, 4 years, 5 years or so. And Kotak dynamic bond fund is also a good option to look at here. And I also said that for the high tax bracket category, I think arbitrage funds are a category which one could also invest in. And the major reason is the high tax rate, especially people who are coming in the surcharge brackets. The arbitrage fund is definitely one to consider.
Okay, thank you so much, Anil. I was about to ask about the different bond investment strategies that you could be working in, but you clubbed it very well in this answer itself. And thank you so much for helping our viewers understand how could this interest rates hike could impact your investments from an investor's and a borrower's point of view. Thank you so much for your time. Looking forward to more. With this, it's time for a short break on the show, but there's more on the other side. So you stay tuned with The Money Show.